Earnings season in the US is in full swing now, and attention is going to turn to the US banks because they are expecting to show sharp declines in the first quarter of the year from a year ago. That is mostly because we did see a very strong trading session last year, and also those banks setting aside those loan provisions in 2020 coming into their earnings last year. Let's take a look now at a few charts of the banks that are going to be reporting, and we're going to kick it off with JPMorgan. It's going to be the first one in the bank section. They're going to be reporting on Wednesday before the market open. Earnings per share expected to come in at 2.69, with revenues coming in at $30.6 billion. Now, a lot of attention is going to be on how the pressures in rising costs are going to be affecting the margins of the bank. And despite these expected interest rate hikes coming in, this could be offset by higher wages and higher costs. That's definitely something that investors are going to be keeping an eye out in the earnings coming out in the next few days. As you can see here for JPMorgan, we have seen a bit of a retracement in recent trading, starting here from the end of March, beginning of April. But on Thursday's candlestick last week, on the 7th of April, we did see potentially a reversal here. Pretty much an engulfing candlestick, if you may. We did see Friday's momentum really pick up, really taking advantage of that lack of body on Thursday, showing that indecision of sellers to bring the share price even lower and starting to pick up some momentum. So a big area of interest for investors this earnings season is going to be what their trading losses or provision for trading losses for this quarter are, especially after a very volatile commodity market. It's going to be interesting to see if that's affected any of their financials. But also the yield inversion, it's been talked about a lot recently. The way banks do their business, the yield inversion is not good for that. So it's going to be interesting to see if elevated oil prices, geopolitical tensions, and also an inverted yield curve signaling recession is going to be hurting the bank stocks even further, because you can see that's been weighing on sentiment in the recent trading sessions. Let's take a look now at Goldman Sachs, and they will be reporting on Thursday. Earnings per share expected to come in at $8.95, with revenue coming in at $11.9 billion. And as you can see here on Goldman Sachs, we've had the similar momentum as JPMorgan, really being hurt from the pullback there at the beginning of 2022. Also from the tensions, geopolitical tensions in Eastern Europe, as you can see, gaining momentum here at the end of February. Now, we have seen a little bit of an attempt to push to the upside. This is likely to do with bank earnings being bolstered by those higher interest rates from the Federal Reserve, especially now that we've got so many interest rate hikes priced into this year. But nonetheless, rising costs and tensions in the market have really weighed on the sentiment here for banks in the US. Goldman attempting to reverse to the upside at the end of last week's trade. Again, we saw that similar momentum here at the end of last week. That reversal on Thursday's candlestick, followed by an engulfing candlestick on Friday, pushing to the upside, attempting to bring buyers into the market. Now, if you are looking for the two trading sessions so far, Monday's session showing a lot of indecision, as you can see, pretty much unchanged on the daily move there, but we have seen a long wick to the upside and also to the downside, showing momentum both from buyers and sellers to bring the share price higher and lower, not quite managing to outweigh there. In today's session so far, that push to the downside showing that sellers were actually on top, seeing a lot more support there, but coming straight back up, and so far today, pretty much unchanged. Again, this has to do with investors expecting good earnings down the line for banks with these higher interest rates, but also a lot of uncertainty with recession warnings and the yield curve inversion. What does this mean for their earnings? Have higher costs meant that their earnings and revenues are going to be hurt? And that's what investors are going to be looking out for in the earnings in the next few days. Let's finish it off with Citigroup also reporting on Thursday. Expected earnings per share at 1.51, revenues at 18.3 billion. It's going to be interesting with Citigroup to see what their comment is around Russia, because they have made provision for losses on Russian business, saying that they could lose nearly half of their 9.8 billion exposure in the Russian economy, the Russian market. So it's going to be a lot of focus there for Citigroup, considering their exposure. They have a lot to lose, and investors are going to want to know if this is going to affect their share price, and that's going to affect their earnings in the next few sessions. Again, we've seen that same pattern, that engulfing candlestick on Friday, attempting to push to the upside. Also on yesterday's candlestick here, that move to the upside above $52 per share, not quite managing to stay above. They're coming all the way down, finishing pretty much unchanged for the day. It's going to be interesting to see on tomorrow's trading session if we do see those strong earnings from JPMorgan, or good market sentiment around those earnings with a good forward guidance based on the Federal Reserve's expected rate hikes. Are we going to see Citigroup picking up a little bit more bullish momentum heading into their earnings on Thursday?
For more videos from us here at IGTV, join us on Twitter at IGCom, Instagram, and subscribe to our YouTube channel.